Welcome to the First Citizens Bank Money Matters presentation on market volatility and your retirement success. Please take a moment to review our disclosure statements before we begin. I'm Emily Jones with the First Citizens Institutional Services team. Thank you for joining us today. It's been a dramatic year in the stock market, and elevated volatility may be here to stay. In light of the market environment, what should you do with your retirement plan? For the next few minutes, we will discuss best practices and key considerations that will give you the best possible opportunity to successfully retire. The first item to consider as we face volatile markets is to keep things in perspective. It's scary to watch the value of your money rise and fall, but there's good news. Though the past is no guarantee of future performance, the market is generally up more often than it's down over the long run. Time and consistency are central when it comes to investing. This chart reflects the S&P 500 spanning from the early 1900s through today, which is a good gauge for the market as a whole. News headlines reporting daily market movement can be unnerving. The yellow circle on this chart reflects the rise and fall of the market over the last 2 years. As we see demonstrated here, market movement is much less alarming with a long-term perspective. 2 items to note. First, markets generally trend upward over long periods of time. Second, history shows us that each market decline is followed by a recovery. As an example, think about the last strong market day in 2008, right before the market plummeted. Even if you invested all of your money in stocks on the day before the financial crisis, you would have recovered your losses and made a positive return simply by staying invested through the recovery. The second key to success during market turbulence is to create a thoughtful plan. How you divide your money across different types of investments is what really matters in achieving your retirement goals. Focus on developing an allocation that's aligned with your goals. I'm sure you've heard the expression, the whole is greater than the sum of its parts. That philosophy applies to planning for retirement. How assets are spread out over different investment options, not the individual investments themselves, generates the bulk of your investment returns. The foundation of creating your portfolio is your risk tolerance. How many years do you have until retirement? What's your comfort with losses? What's the size of your retirement needs? These are all key factors that impact your ability to take a hit in the market. As you near retirement, the risk level of your portfolio should generally decrease. The amount you've invested in safer assets, like bonds, should increase as you age, while at the same time decreasing the amount you have in higher risk investments, like stocks. Keep in mind as well that not all your funds will be needed on day one of retirement. You may still need to fund your income for 20 to 30 years beyond your retirement age. Some of your assets may be able to remain in equities that are expected to grow over time. A helpful rule of thumb is that funds needed for the next 5 years should not be invested in equities or risky asset classes. If dollars are not needed for more than 5 years, even after you've retired, funds may be considered safe to remain in equity-based investments. Target date funds, which are probably offered in your retirement plan, can be helpful in this respect. Target date funds are professionally managed asset allocation investment options based on your years to retirement. While it's true that significant asset allocation changes to your portfolio during times of uncertainty are generally not helpful, there is one important reason to check on your retirement plan assets during a market downturn. When market returns increase or decrease significantly, your overall portfolio asset allocation may drift from your original intent. For example, if the value of equities falls substantially, the percentage of your portfolio invested in equities falls as well. you may have less in this bucket than you intended. It's a great time to rebalance your portfolio to its intended targets. Rebalancing your retirement investments with a clear head to a target percentage is timely and important. In most retirement plans, it's possible to set up an automatic rebalance on a scheduled frequency. This is a great option for you to consider. If you choose to invest in a target date fund, it will automatically rebalance for you. Once you've created your plan, stick with it, even when the market feels unnerving. Don't try to time the market. The market is smarter than you think. By the time you notice headlines that would drive your investing decisions, market prices have likely already reacted. Even very sophisticated investors tend to fail more often than they succeed when attempting to time when to put money in or pull money out of the market. Johnny and June both started out with $100. Johnny missed only 20 of the best trading days between the years of 1998 to 2018. June acted smartly and stayed invested, not moving money in or out of her equity holdings, and her $100 turned into nearly $400. Johnny, on the other hand, ended the period with a loss. In general, market timing makes you more likely to sell at a lower price and buy higher. It's true that success or disappointment often boils down to just a few days in or out of the market. This means that we should focus on time in the market, not timing the market. We cannot guarantee future returns, but remember and take comfort in the fact that the market has historically trended upward over longer periods of time. Generally, moving money to safer assets in a downturn out of fear will cause you to miss opportunities to benefit from the recovery. Instead, try to review your investment risk tolerance with key life events, like the birth of a child or a marriage, and more often as you get closer to retirement. And remember, if your goals and timeline haven't changed, your investment strategy shouldn't either. If possible, continue investing in your retirement plan when the market turns. There are particular benefits to contributing in this type of environment. When the market corrects, the value of securities fall. This essentially means that when you add money to your retirement plan, you're buying at a discount, like purchasing securities on sale. Your retirement plan facilitates the opportunity to participate in dollar cost averaging. Dollar cost averaging is investing set amounts over a period of time. In respect to your retirement plan, it's the amount you're deferring from your paycheck. Dollar cost averaging reduces your risk and may enhance the growth of your portfolio. If maintained consistently, it will result in more units purchased at lower prices and less units at higher prices. This benefits you by allowing you to purchase more and benefit more as a result from the market recovery, because all those shares you purchased at a lower price will appreciate at a faster pace. At the end of the day, time is your friend. Over time, compounding interest allows your money to build on itself. The earlier you can begin investing consistently, generally the better off you'll be. Now let's recap what we've discussed. Context is important. Though past performance is no guarantee of the future, the market has historically been up more often than it's down. Thoughtful allocation is the most important factor in achieving your retirement funding goal. Diversify between different types of investments and remember to rebalance periodically. Stay committed to the plan you created when emotions were not running high. This gives you the best opportunity to achieve your goal. When the market corrects, you're able to buy more units at a lower cost. If possible, keep contributing. Time in the market is one of the most powerful tools available to you. Thank you, and if you have any questions, please contact your First Citizens Relationship Manager.